Hello, and welcome to Tax Talk by Greenspoon Marder. My name is Nick Richards. I'm your host today. I'm a tax partner with Greenspoon Marder, a large AmLaw 200 law firm here in the United States, providing full services to its clients across the U.S. Today, we're going to talk about the one big, beautiful bill. And with me, I've got a big part of the Denver tax team. Really excited today to have the team on the program with me. We've got our senior counsel, Sabrina Strand. Sabrina's going to kind of provide some sort of narrative and some insight as we go through today's topics. We've also got Alexis Whitley, who is an associate in our office. She's going to talk about overtime and changes in the taxation of overtime. And finally, Tatum, who is one of our counsels, she's going to talk about the new deductions for tip workers. There's a lot here, folks, and these topics are important both for the individuals out there, the waitresses and the waiters and the people who get tips and the people who work overtime, but also the employers of those people as well. So we're going to try to kind of hit both sides of that a little bit and make sure that we all understand what's going on and what these new requirements entail. So the one big, beautiful bill, I don't have a stack of it here, but there's a lot in it. And starting us off first is going to be Tatum. And Tatum, so tip workers, new deductions for tips, right? Is it just that simple? Is it, hey, I get tip? Can I convert my salary to tips? What's going on here? Tell me about it.
Well, this is a provision that's part of the bill because there are, the traditional tipped workers who have a less than predictable take-home pay. So no, unfortunately, it's not for people like us. In fact, we are specifically excluded, and it's not for even someone that you give a really big tip to just, because they've done a great job. It does really apply to those people who are in traditional service industries like servers and bartenders and people in the beauty industry. There is a very long list, so it's far more comprehensive than that. But these people who are often in a wage that isn't yet minimum wage because those tips are supposed to create some sort of differential, but they're voluntary tips, so there's not any sort of predictability on what that number will be. So this allows for a $25,000 above the line deduction, which means that you don't have to itemize in order to take advantage of it for those tips. And I think I should specify that those are $25,000 worth of qualified tips, which, as we know, is nuanced and sort of creates a bifurcated reporting for employers.
Qualified tips. That sounds like something that we probably need to dig in a little bit on, Tatum. But you did say that it is available for filers that don't itemize. Is that right?
It's true. Yes, you can. So in either instance, it's above the line. So, and for anyone who's like, where is the line? The line is for your adjusted gross income. So even if you just take the standard deduction, this deduction is available to you if you have, some percentage of your income that is considered a qualified tip.
So there must be some qualification limits here. Are there some income limits? Are there some things like that? Or is it just if you get tips, you're good to go?
It does start to phase out at over certain income limits because the policy behind it is to, directly benefit these people who are typically in, again, unpredictable, but also like lower tax brackets. So I think that the phase out is it's 150 single filer, 300 for married filing jointly. I might be slightly off with those numbers, but it does start to phase out at those higher income levels just because it's not typical for someone who does only work for tips or has a small wage and then is primarily tipped to really exceed those income thresholds. So it does start phasing out. And again, it is specific to industries that the government qualifies as tipped workers. And the list is pretty long. Typically, it's released each year in October, and we don't yet have the most current version because of the government shutdown. But it's lengthy, and it's there are some surprises in there, but if you give your loan officer $500 because he closed you ahead of schedule and that's a really great bonus, he or she can't claim that 500 as a deduction because they're not in a tipped profession. So it doesn't apply to everyone. That's just income or a gift. It's only those people who traditionally work in tipped professions.
Okay, Tatum, and you also said something about a qualified tip. Is that we've got individual requirements and then the tip itself? Are there some requirements around that as well?
Yes, as we've learned, not every tip is a qualified tip. So there's some rules around that, particularly with the service charge that's added in a lot of restaurants now, particularly here, in Colorado, you see that. And it's like a community fee or a living wage fee, and it's often divided among all the personnel, front and back of house. That's not optional for diners, so that would be considered just part of the bill. The same is true if there's an automatic gratuity added for large parties, or if just a restaurant automatically adds any kind of service fee. The customer doesn't have the choice to pay that. So it's considered non-optional and therefore not qualified. Anything above and beyond that is, when the customer actually has to make that choice. It's only that level of gratuity that falls into that qualified category.
Interesting. Tatum, as you know, we have clients in all kinds of different industries, but one of the more challenging industries where we have a lot of clients is in the cannabis space. And I wonder if bud tenders, I don't think that's PC. I think we want to call them salespeople. But if bud tenders, do they qualify for this? Does this include the sin trades?
Well, a bartender certainly is on that list year over year, and not every state. And of course, there is that federal state tension within the industry. And here in Denver, our budtenders, our salespeople, are typically paid that regular wage, not the tipped wage, which allows for that differential. But I think that the industry norm really shows that those people do have a substantial portion of their pay that comes through tips. I think if you interviewed nearly anyone who shops in those establishments, they always do expect to tip something. So it would seem that the comparison between budtenders and bartenders being similar to what it is should allow that deduction in that space as well. It seems to be, a fair comparison.
Yeah, that makes sense.
Nick,
yeah, Sabrina, what do you think?
I just want to preface this by saying this question was actually asked to Treasury and there was a FAQ issued. And Treasury has stated that if you are in an illicit industry that provides illicit drugs or prostitution, any tips given is not allowed as a qualified tip. And one of the questions asked was about, industries that are legal on the state side, but illegal federally. And their view is that is an illicit industry and will not allow for qualified tips.
Interesting. Sabrina, that sounds like something that's ripe for challenge to me.
Yeah. So the FAQs right now, they could change, right? They could change, but it very much said that if you are tipped within any type of illicit industry, drug, gambling, like anything like that, not allowed as a qualified tip.
And alcohol is not an illicit industry?
Not, unless you're a bootlegger. But, I think this goes to the question of, how it's going to be presented in a W-2, and it's going to be nuanced. Does IRS pick up on the fact that a bud tender is in, or a salesperson is in this industry when their W-2 is filed? I don't know.
Well, Sabrina, it makes me think, this is another reason why cannabis companies, which already have multiple entities to accomplish things like banking, might might continue to find a need to have a separate entity from their licensed company that can provide a little bit of shelter for their employees and maybe get them qualified for these tips.
Yeah, I think too, my hometown is Las Vegas, and an industry is legal there outside of Las Vegas city limits and outside of Reno city limits, and prostitution is legal. And they get tipped, right? And so I think that's another industry that should look into this, because in Nevada, and I think maybe another state, that is legal. And so this is another industry that's going to have a carve out where tips will not be allowed to be deducted.
And would it also be a carve out for just tipping the dealer and stuff like that? That's also.
So dealers are allowed, and they did say that dealers are generally tipped in chips, and so chips qualifies as a cash tip, a tangible tip. And so it's very the FAQs are very nuanced, right? So if you work for a casino, generally speaking, a lot of the jobs within a casino are not considered a tip, like a tip employee. But there's certain, if you were like a bartender at a casino, or you're a lounge singer, those you have to look at like what your actual role is within that industry and go back to that list that Tatum was talking about. So there's many layers to this, but a dealer would be allowed to deduct tips. Managers, no, but dealers, yes. Lounge singers, yes.
What about if I leave a couple chips on my bed for the maid to pick up the next morning? Does that work?
It would. I think this also goes back to, the question of, in general, is a tip like that even being picked up on a tax return?
Of course it is. Of course. Sabrina, Tatum, thank you so much, both of you. We're not going away. We've got Alexis next. She's going to talk to us about changes that have occurred as far as overtime pay. And I'm sure Sabrina's got some good insight on that as well that she'll chime in on. So, Alexis, tell us overtime pay. Who gets that? Who gets overtime pay? What's going on there?
Yeah, so overtime pay is something that individuals, which are covered by the Fair Labor Standards Act, get. So this One Big Beautiful Bill Act made a couple of changes to the way overtime pay is taxed. Prior to this legislation, it was taxed like any other wage, but now there's a new provision in the Internal Revenue Code, and that's Section 225, which is titled Qualified Overtime Compensation. And under this section, individuals can get a deduction for what is considered qualified overtime compensation, and that's defined by reference to the FLSA that Nick referenced. So the FLSA separates workers into two categories. You have exempt workers, and then you have non-exempt workers. So exempt workers are typically individuals like professionals, executives, managers, and the like. And these employees aren't subject to FLSA requirements because they meet certain salary and duty tests. However, non-exempt workers are covered by the FLSA, which means that they are required a minimum wage as well as overtime compensation. And these workers are typically blue-collar workers, retail clerks, restaurant servers, and kind of similar positions to those. So with this, individuals can now deduct qualified overtime compensation. And again, that's by reference to the FLSA. So this actually presents a pretty unique horizontal equity issue where you could have two workers with the same annual pay, and they might wind up owing different amounts in taxes. So your hourly workers that are covered by the FLSA can deduct part of this overtime, but salaried workers who work the same amount of hours and receive the same pay can't. So this presents an opportunity that Sabrina will delve a little bit more into, where employers can really benefit their employees without changing their bottom line if the employee can appropriately be reclassified as a non-exempt worker.
Alexis, that seems super messy. And it makes me think about things like the earned income tax credit and some other things that were messy that the IRS had a real hard time auditing. And this seems like a similar mess to me. Sabrina, what do you think? Do you want to chime in here? Or do you want, I know that Alexis has got a little more for us. Do you want to talk a little bit about Alexis? I had to Google it. Horizontal equity. I didn't get that one in law school when I was going. That must be a new term.
I might let Alexis chime in on, how much overtime is taxable, and then dive in on, how employers and employees go about making sure that they can take this deduction.
Yeah, so there are a few limits on how much overtime is non-taxable. So for starters, the deduction applies only to the portion of overtime pay that's a bonus over a regular wage. So in layman's terms, this means that the half and 1.5 time pay is considered non-taxable overtime. So if you have an employee who makes $40 an hour, but they work some overtime, then they would be making $60 an hour. But only that $20 delta is what's considered qualified overtime compensation that is non-taxable. The deduction is also capped. So you can only deduct up to $12,500, or if you're a married filing joint couple, up to $25,000. And the deduction, similar to the deduction for tips, also has a phase out. So it phases out at 10% for single taxpayers making over $150,000. Or for married filing jointly, that's $300,000. And interestingly, married couples have to file jointly if they want to take advantage of this deduction. So that's something to be aware of if you are married but happen to file separately. This deduction also only applies to federal income taxes, so your federal payroll taxes are not going to be affected by this legislation. And currently it's effective for 2025, and it's scheduled to expire in 2028 unless it's extended. Now, this presents some interesting reporting implications. For the 2025 taxable year, individuals can approximate the amount of qualified overtime compensation that is reported by any reasonable method that the Treasury prescribes. Currently, we don't have any Treasury regulations kind of discussing this no tax on tips or overtime. But it should be noted that the American Institute of Certified Public Accountants actually submitted a letter last week to the IRS and the Treasury, where they recommended some guidance on the no tax on tips and overtime for the 2025 year. And part of this recommendation also included a safe harbor for this specific year, since the reporting requirements are going to be a little hard to manage.
Thank you, Alexis. For those of you out there who are small business restaurant owners and other kinds of businesses in this area, where overtime is paid or tips received, or both these topics, hey, we're here for you. We want to talk to you. We want to help you guys through this process. It's a new area of the law, and it's going to take some time to sort of settle out. And as you can see, we have an amazing team at Greenspoon Marder that really understands the law and the obligations that you might have. So we really want to help you with that. I'm not saying goodbye yet. We got a little bit more here to go. Sabrina's got some insight for us on this as well. Sabrina, what is all this? Where are we going with this stuff? Is this gonna be the audits of the future for those of us that handle audits? Is that where this is all going? What's the deal?
I hope not, because we're in trouble. It's gonna be a lot to unravel, both on the employee side and the employer side. If I could jump back to tips, what Tatum was speaking on, there's a couple of things that I think employers especially should start thinking about. The first is what Tatum said with a qualified tip. So the Treasury has really come down on this. They want taxpayers or clients to have the option to opt out of a required tip. And so the first thing I think you can do, if you don't want to start separating qualified and non-qualified tips, is add language to your menus, to the bill that says that you have the option to opt out of this service charge or opt out of this tip. That's the first thing that the Treasury has said. The second thing is when it comes to like the handheld devices that we all use nowadays, where you tap your card to pay. If there is not a no tip option, right? That also does not qualify as a not, that will not qualify as a qualified tip. So what do I mean? Like when you pay your bill, it has an option generally that says like tip 15, 18, 20%, or you can click other. If there's no tip option, then anything you tip above 15% would be a qualified tip. But if you tipped 15, it would be a non-qualified tip. This is going to create a logistical nightmare for any industry, whether it's a small business, a restaurant, hair salon, just trying to piece out how you go about tracking non-qualified and qualified tips. So what Alexis was saying is that the AICPA has asked for guidance in safe harbor, right? Because we are in October, the end of October, and W-2s will be issued, 1099s will be issued in January. How do you decide what is a qualified tip, non-qualified tip? I don't think anybody has tracked that. And so IRS is saying use reasonable standards. The other issue is that the W-2 and the 1099s did not get updated for 2025. So there will not be a box that says qualified tip, non-qualified tip. It's just going to say tip on the W-2. And, I think a lot of employers don't know that there is a difference now. And so they'll probably just put it all on the tip line, which could lead to an audit. I would say that the industries should start now in looking at this, like looking at their tipping practices, how they track it, especially going into 2026, because 2025, I think Treasury is going to have to relax some of this just because it is so late to the game. OB cubed, as I like to say, the one big beautiful bill was passed July 4th, halfway through or more than halfway through the year. And so it did not give all these industries time to really implement this. So going forward in 2026, we can help you. We can, talk about strategies in how you make sure that your client or your employees get the full benefit of this, because I can't imagine you telling your employee that, they've been serving and none of the tips they receive will be qualified tips because of a line item you have on your bill. That would be earth shattering. The other thing is that in the senators from Nevada asked a question about tips, and for married filing joint taxpayers, the cap is $25,000. And so the question was, if you are in a service industry where both husband and wife or husband, wife work, do you get to double that number, right? Do you get to take 50,000? And Treasury has come back and said, no, it is 25,000. Whether it's single, 25,000, whether it's married filing joint. If you file married filing separate, it's zero. So
That doesn't make any sense.
No, it doesn't. It does not. But they have come out. I know that many members in the legislature who have communities that will be impacted in this are trying to find ways, but Treasury has come back and said that if Congress intended for it to be a double, they would have put it into the bill. So there might be a rider in one of the new bills that fix this, but for 2025, if you file jointly and both of you are in the service industry, it is a $25,000 max. So something to think about. And then for overtime, kind of what Alexis was saying with respect to like horizontal and exempt, non-exempt, one thing that employers should think about is, maybe giving, you can give an employee a benefit to using this overtime tax reduction, or no tax on overtime, by simply shifting them from exempt to non-exempt. And it would make a big difference on their final tax bill just by doing that. It doesn't cost the employer really anything, but that making that adjustment is huge. The other thing that I want to note for 2025 especially is that there will be no box that details overtime. It will all be included as income. And so employers need to track the overtime pay, that delta that Alexis was talking about, you know, her example where she said if it's a $40 an hour employee and their overtime is 60, it's the $20 that would not be taxable. Employers are going to have to track that, and they're going to have to provide their employees at the end of the year with a statement attached to their W-2 explaining how much of their total income should not be included as overtime pay. So that is why the AICPA is asking for, you know, a safe harbor provision, because when you take your documents to, you know, an accountant or H&R Block or a Vita site, they're not going to know, right? They're just going to see a W-2 box with like wages. How are they going to be able to decipher how much of this was overtime? How much of this can we, you know, remove? And this is where, you know, for employees, this is where it's going to become difficult. And, you know, having, you know, your pay stub, which would tell you how much you made in overtime, is going to be helpful. But 2025, I think, will be a little bit difficult because everybody's trying to put the pieces together and you know, implement things to abide by the new legislation. But I think 2026 really, like, you know, knowing that we're going to use reasonable efforts to get it right, implementation for 2026, 2027, 2028 are going to be key.
Folks, this is complicated stuff. And as you can see, we've got some really smart ladies that has got this all figured out. If you have questions, give us a call. You'll see our information at the end of the program today. Tatum, Alexis, anything you'd like to add?
I think Sabrina covered it. Just being proactive in this space and really kind of trying to get ahead of what these changes are implementing will be really important, especially for the 25 tax year.
Smart words.
And, you know, helping yourself by tracking what you can and not relying on your employer to do that for you. If you are one of these people, you know, starting in January, right? It was hard to do this year, but you can keep your own good records. Then if you ever are audited, you're set up for success.
Thank you so much for joining us today. We are Greenspoon Marder, the tax team out of the Denver office. We're here to help you, and we look forward to talking to you. Have a great day. Thank you.